A quota share treaty is a type of proportional reinsurance where the insurer and the reinsurer agree to share a fixed percentage of premiums, losses, and expenses related to a specific portfolio of policies. This sharing applies to every policy within the portfolio, with both parties assuming their predetermined portion of risk. Key features of a quota share treaty: proportional risk sharing, the reinsurer and the insurer share premiums and claims based on the agreed percentage. For example, in a 70% quota share treaty, the reinsurer assumes 70% of premiums and covers 70% of claims, while the insurer retains 30%. Fixed percentage, the percentage of risk sharing remains constant throughout the treaty, ensuring a predictable distribution of both premiums and claims. Automatic coverage, the treaty applies automatically to all policies within the agreed portfolio, eliminating the need to reinsure each policy individually. Expense sharing, in many cases, the reinsurer also shares administrative and other expenses proportionally. Example of a quota share treaty. If an insurer writes a $1 million policy with a premium of $50,000 under a 60% quota share treaty, the reinsurer receives 60% of the premium. The reinsurer covers 60% of any claims, so if there's a $200,000 claim, the reinsurer would pay $120,000, while the insurer covers $80,000. Benefits of a quota share treaty. Capital relief. By sharing risk, the insurer can reduce the amount of capital it needs to hold, freeing up resources for other business needs. Risk diversification, the insurer reduces its exposure to large losses by spreading risk with the reinsurer. Increased underwriting capacity, insurers can write more or larger policies than they could handle alone, as the reinsurer shares the risk. Earnings stabilization, the fixed percentage of shared premiums and losses helps smooth financial performance, reducing volatility from large claims. Administrative simplicity, the treaty covers all policies in the portfolio, reducing the administrative burden of seeking reinsurance for individual policies. Drawbacks of a quota share treaty. Premium sharing, the insurer cedes a portion of its premium income to the reinsurer, potentially reducing profitability in years with low claims. Ceding commission, the reinsurer may provide a ceding commission to cover the insurer's expenses, but if it's too low, the treaty may not be as profitable for the insurer. Limited flexibility, the fixed sharing ratio limits the insurer's ability to adjust how much risk to retain or cede based on market conditions. Over-reinsurance, the insurer may unintentionally cede too much of its profitable business, reducing its overall profit margin. Use cases for a quota share treaty. New or growing insurers looking to expand their business without taking on too much risk often use quota share treaties to increase capacity while maintaining financial stability. High volatility lines of business, insurers writing policies in sectors prone to high volatility, such as catastrophe or liability insurance, can use quota share to protect against large losses. Capital management, insurers seeking to optimize their capital usage and reduce regulatory capital requirements often turn to quota share treaties. Structuring a quota share treaty. When negotiating a quota share treaty, insurers and reinsurers must decide. Quota percentage, the portion of premiums and losses the reinsurer will assume. Ceding commission, the reinsurer typically pays a commission to cover the insurer's acquisition or administrative costs. Portfolio, the types of policies and risks included in the treaty. Term, the duration of the treaty, typically 1 year, with the option to renew. Conclusion. A quota share treaty is a useful tool for insurers looking to manage risk, expand their underwriting capacity, and stabilize their earnings.